You're paying what I call the just-in-case tax every month without realizing it. Maybe it's $83 extra on your homeowner's policy. Perhaps $47 more than necessary on auto coverage. Could be $92 you don't need to spend on life insurance. Add it up, you're bleeding over $1,000 annually. Not because you chose badly, because you chose like most Americans choose, with your gut instead of the numbers. Here's what I discovered researching wealth accumulation patterns over 25 years. The pathway to financial independence isn't paved with big wins. It's built from hundreds of small decisions. And insurance. That's where most people get it wrong. Today, I'm showing you how to fix this in 5 minutes, once a year. Not 5 hours, not 5 days, 5 minutes. Let me tell you about a study that changed everything I understood about insurance decisions. Justin Sidnor, a researcher at the University of Wisconsin School of Business, examined how consumers choose insurance deductibles. His findings? Absolutely shocking. 83% of people select deductibles that are dramatically too small. What does too small mean? Here's the math. Many consumers chose a $500 deductible over a $1,000 option. Seems reasonable, right? Lower deductible feels safer, but look closer. The average expected benefit from that additional coverage, just $20 per year. The cost, 5 times that amount, around $100 annually. People were paying $100 to receive $20 in expected value. Now, you might think, well, I'm risk averse. I'm conservative with money. That's why I pay extra. Sidnor tested this explanation. He calculated what level of risk aversion would justify these choices. The answer stunned economists worldwide. Your coefficient of relative risk aversion would need to fall between 1,840 and 5,064. What does that mean in plain English? Someone with a risk aversion of 5,000 would reject a bet offering a 50/50th chance of either losing $1,000 or gaining $1 trillion. That's $1 trillion. You wouldn't take a coin flip for $1 trillion to 1 payoff. Nobody actually thinks like that. Not even the most conservative retiree I've ever met. So why do we make these choices? 2 psychologists, Daniel Kahneman and Amos Tversky, won a Nobel Prize answering this question. Their work revealed something fundamental about human decision-making. Something insurance companies understand perfectly. Something you need to understand too. It's called prospect theory. Here's what it says. Losses hurt approximately twice as much as equivalent gains feel good. Finding $100 on the sidewalk? Nice feeling. Losing $100 from your wallet? Devastating. The pain is roughly double the pleasure. This asymmetry shapes every insurance decision you make. Kahneman and Tversky discovered that we overweight small probabilities when facing potential losses. Translation? We dramatically overestimate the likelihood of needing that low deductible. Your brain performs this calculation unconsciously. It screams, what if something happens? What if I need to file a claim? That what if feeling overpowers the actual math. Insurance companies don't fight this tendency. They profit from it. Think about how they market to you. They don't emphasize statistical probabilities. They paint vivid pictures of disaster, house fires, car accidents, medical emergencies, lawsuits. They're not lying. These things happen. But they're exploiting what researchers call loss aversion to sell you more coverage than you need at prices higher than necessary. A 2017 study by Saurabh Bhargava, George Lowenstein, and Justin Sidnor examined employees at a Fortune 500 company. These were educated, successful professionals, people who should know better. Researchers found that most chose expensive, low-deductible health plans when a high-deductible option would have saved them an average of $350 per year, every year, without exception. In every spending scenario the researchers modeled, the high-deductible plan cost less overall. Yet people kept choosing the expensive option. Why? Because comparing insurance plans triggers what psychologists call narrow framing. You isolate the decision. You don't integrate it with your broader financial picture. You think, I want the $350 deductible, not the $1,000 deductible. You don't think, I have $15,000 in my emergency fund. A $1,000 deductible wouldn't strain my finances, and I'd save $350 in premiums annually. Over 10 years, that's $3,500. See the difference? One frame feels safer. The other frame is actually safer. Academic research from the University of Pennsylvania's law school revealed that Americans collectively waste $4.8 billion annually on unnecessarily low homeowners insurance deductibles. $4.8 billion. That's not a typo. Your share of that waste? Probably somewhere between $800 and $1,200 per year across all your policies. But here's what makes me optimistic. This problem has a simple solution. Not a complicated solution. Not a time-consuming solution. A simple solution. I want you to call your insurance broker tomorrow. Not to cancel anything, not to switch companies, just to ask 3 questions. These questions leverage everything we've discussed about behavioral economics, loss aversion, and narrow framing. They force a different conversation than the one your broker typically has with clients. Here they are. If I increased all my deductibles to the highest available option, how much would I save annually in premiums? Notice what this question does. It reframes the decision. You're not asking, "What do you recommend?" You're asking for numbers, specific numbers. Your broker will give you those numbers. They have to. It takes them maybe 90 seconds to run the calculation. Write down that annual savings figure. Now perform a simple calculation. Multiply it by 10. That's how much money you'll save over the next decade if you make this change and never file a small claim. Which, statistically, you probably won't. Most people overestimate their likelihood of filing claims by factors of 3 to 5, according to behavioral insurance research. But let's be conservative. Let's assume you file 1 claim during that decade. Subtract your higher deductible amount from the 10-year savings. Still coming out ahead? That's your answer. What's the actual claims frequency for someone with my profile? This question cuts through the emotional fog. Your broker has this data. They know what percentage of customers like you, similar age, similar home value, similar vehicle, similar health status, actually file claims each year. The answer will surprise you. For homeowners insurance, most people never file a claim. According to the Insurance Information Institute, the average homeowner files a claim once every 9 to 10 years. For auto insurance, it depends on your driving record. But if you haven't had an accident in the past 5 years, your statistical likelihood of having one next year is remarkably low. For life insurance, well, we'll all need that eventually. But term life versus whole life, that's a different conversation. One that deserves its own video. The point is, get the actual numbers, not the fear-based marketing, not the worst-case scenarios, the numbers. Can you show me the total cost of ownership for each option? This question forces transparency. Total cost of ownership means premium plus expected out-of-pocket expenses plus opportunity cost of the premium difference. Let me explain that last part. Say you're choosing between 2 homeowners policies. Policy A has a $500 deductible and costs $1,500 annually. Policy B has a $2,500 deductible and costs $1,200 annually. Policy B saves you $300 per year in premiums. Over 10 years, that's $3,000. If you invested that $300 annually in a simple index fund earning 7% average returns, you'd have approximately $4,140 after 10 years. Now suppose you file 1 claim during that decade. You pay $2,000 more out of pocket than you would have with the lower deductible. You're still ahead by roughly $2,140, and that assumes you file a claim. Remember, most people don't. This is the calculation insurance companies hope you never make. Because once you make it, their profit margins shrink. Your wealth grows. Here's how you lock this in permanently. Not through constant vigilance, not through quarterly reviews, through automation. 5 minutes, once a year. Here's the system. Step 1, the calendar reminder. Right now, before you finish watching this video, create a calendar reminder. Pick a date that means something to you. Your birthday, New Year's Day, tax day. The date doesn't matter. Consistency does. Set a recurring annual reminder titled Insurance Audit, 5 minutes. That's it. That's step 1. Step 2.0, the template. I've created a simple template for you. It's in the description below. Download it, save it somewhere you can find it. This template has 3 sections. Section A, current coverage details. Section B, the 3 questions with space for your broker's answers. Section C, decision matrix. The whole thing fits on one page. When your annual reminder pops up, open the template. Fill in your current coverage details. This takes maybe 90 seconds. Then schedule a 15-minute call with your broker. Tell them you're doing your annual insurance review. Ask the 3 questions. Record their answers. That's another 3 minutes of actual work. Now comes the decision matrix. Step 3, the 2x rule. This is the decision framework that simplifies everything. If raising your deductible saves you more than 2x the premium difference over 10 years compared to the deductible increase, make the change. What does that mean? Example, raising your homeowner's deductible from $1,000 to $2,500 increases your out-of-pocket risk by $1,500 if you file a claim. But it saves you $300 annually in premiums. 10-year savings, $3,000 not counting investment returns. $3,000 is exactly 2x your increased risk of $1,500. Make the change. Why the 2x rule? Because it accounts for loss aversion. Remember Kahneman and Tversky? Losses hurt twice as much as gains feel good. So we require gains to be twice the losses before we make a change. This keeps you from second-guessing yourself emotionally while still capturing the financial benefit. Step 4, the review lock. Once you've made your decision, lock it in for the year. No revisiting. No reconsidering. Behavioral economics research shows that repeated reconsideration leads to worse decisions, not better ones. You fall back into emotional patterns. You made a rational choice based on numbers. Trust it. Next year, you'll review again. Maybe your situation changed. Maybe your assets grew significantly. Maybe you paid off your mortgage and your risk tolerance shifted. Fine. You'll account for that in next year's 5-minute audit. But for this year, done. Let me show you what this looks like over time. Average American household with standard insurance coverage. Homeowners, $83/month overpayment. Auto, $47/month overpayment. Life, $63/month overpayment. Total monthly overpayment, $193. Annual overpayment, $2,316. Now let's be conservative. Let's say you can't optimize everything immediately. Maybe you cut that overpayment in half. You're saving $1,158 annually. Invested at 7% average annual returns over 20 years, $47,437. That's not a typo. Nearly $50,000 from one 5-minute audit annually. But it gets better. Because this isn't just about the money. Though the money matters, it's about what researchers call agency. You took control. You stopped paying the just-in-case tax. You stopped letting fear drive your financial decisions. You started acting like the wealthy people I've studied for 2 decades. The ones who built substantial assets not through big wins, but through hundreds of small, rational decisions. This is one of those decisions. Insurance companies are not your enemy. But they're also businesses optimizing for profit. They understand prospect theory and loss aversion better than most psychologists. They know exactly how to price policies so you overpay while feeling like you're being careful. The choice in front of you is simple. Continue operating on emotion, gut feel, and better safe than sorry thinking. Or spend 5 minutes annually making rational decisions based on actual numbers. 5 minutes to reclaim over $1,000 per year. 5 minutes to compound that into tens of thousands over decades. 5 minutes to shift from consumer to accumulator. I've shown you the research. Sidner's data on deductible choices. Kahneman and Tversky's Nobel Prize-winning insights on loss aversion. Bargava and Lowenstein's findings on dominated options. I've given you the 3 questions that reframe the entire conversation. I've handed you the 5-minute automation system that makes this effortless. The template is in the description. The research papers are linked below if you want to dive deeper. Everything you need is here. What happens next is up to you. Will you take action? Or will you keep paying the just-in-case tax? Your future self is watching. Make the call, do the audit, reclaim your $1,000. Then come back and tell me what you discovered. I read every comment. I want to know how much you saved. Thanks for watching.